Well, welcome to the Fairhaven Look Ahead of 2024. Thanks for joining us. Really looking forward to walking you through a recap of what 2023 was like and then what our thoughts might be for what's on the horizon in 2024. I'm Mark Horner, founder of Fairhaven Wealth Management, and there's going to be opportunity for questions near the end, but really looking forward to making this an interactive discussion as much as possible. So let's set the agenda real quickly. So what we're going to talk about is we've taken a stab here at going with a nautical theme. So a little bit about the difference between 2022, which I have to confess I'm thrilled is behind us, and 2023, what the Fed is up to in their war on inflation, the selectivity of rising tides in the investment market. So that phrase that a rising tide lifts all boats often is not the case in the investment world, and that was very much the case in 2023. The setting aside the fear that maybe we've missed the boat, a little commentary on the persistence of the rockiness of the ride in the investment markets, and then I'm really going to go out on a limb to try to put a rosy picture on the political landscape because we've got a presidential election that's coming one way or another for us. So I know I'm setting the bar pretty high, but I'm pretty confident that we'll be able to pull some positivity out of the political world. So let's get into a recap. So this slide here really says it all. So on the left-hand side, in the middle, you can't miss it with all the red numbers. That's what we were talking about this time last year. Just absolutely nowhere to hide in any of the investment world. And what a snapback we had here in 2023. All those red numbers go to black numbers. So very easy to come off of the heels of 2022 and think, what in the world am I doing in the investment market? But that is just the nature of the experience. That patience does pay off, and often when you're hating your investments the most, that's can be a really good sign that there are good things to come, and that was absolutely the case in 2023. One of these, that top left-hand side, you're going to see the U.S. is represented by the S&P 500, did quite well, but right on its tails there was the international markets, and so we're going to talk a little bit more about that as we move on. Fixed income was so the other side of the asset allocation equation was a similar story. This slide is not quite as dramatic. So you've got yields over on the left-hand side, where you look down the yield columns between where we finished the year and then where we were a year ago, and those yields are somewhat similar. What's not being reflected in those numbers is the price depreciation that a lot of the fixed income markets experienced in 2022, which we were largely able to avoid in 2023. And then for those of you that missed this presentation last year, we highlighted quite strongly the performance of TIPS. So that's the third line down. What that stands for is Treasury Inflation Protected Securities. And so if you had a crystal ball and knew what the inflation landscape was going to look like going into 2022, you would have backed up the truck to something that had inflation protection in its name as an investment. And quite cruelly, as the investment markets can be, something that seems so obvious ended up being a horrible place to be. So the TIPS market in the fixed income world was among the worst performers, and really here not really giving you much additional yield. So a big contributor to why the fixed income markets and the equity markets had such a rough go in 2022 was what the Fed was doing to try and tame inflation. So they are limited in the toolboxes that in the tools that they've got available in their toolbox, but the biggest one is raising interest rates. And if you look at the right-hand side of this chart, you're going to see the inflation line, so that's that blue line, peaking in late 2021. And so again, this time last year, we began to see the rollover of the inflation numbers starting to come down. And we talked about last year, it's looking like what the Fed is trying to accomplish. So they're trying to get inflation down without hurting the economy too much. Last year, we said that looks like it's working, and that trend continued. So the Fed is doing a very good job in trying to walk an incredibly thin tightrope of bringing inflation down while not hurting the economy too much. Just the other day, the most recent GDP numbers, which stands for Gross Domestic Product, it's a measure of how the economy is doing, came in above 3%, which is a wonderful growth rate. So again, the Fed looks like it's threading the needle, but that there's more to come on that. So again, with the Fed, the biggest tool that they've got in their toolbox are interest rate moves. So this chart is both a historical look at where interest rates have been, and then a forecast based on Wall Street opinions about where interest rates might go. So that right-hand side of the chart, you're seeing that basically vertical line in 21, 22. That's the Fed aggressively raising interest rates again to battle inflation. And it looks like they're set up now for a pause, and the Wall Street prognosticators that's the dotted line to the right, are all seemingly and frankly confusingly to me calling for interest rates to decrease. I've started my third decade in this business, which makes me older hopefully than I look, but I don't understand this at all, because what's going on in the environment right now is we're getting very solid economic growth, so that's good. Unemployment is staying relatively stable, so people are not losing their jobs left and right, so that's good. And what the Fed has done from an interest rate perspective has brought rates back to more of a normal, what's really a normal range. And so why Wall Street would forecast the Fed would be decreasing rates, to me just doesn't make any sense. If you can have your cake and eat it too, get strong economic performance, have the economy perform well, and actually get some yields in the fixed income world like CDs and your savings account, why in the world wouldn't you stick with that policy? But that just remains to be seen. So this is a look back, and if you look at the bottom of this range, this is going back a long time, so back into the 1800s, and I know those numbers can be a little hard to read. So that blue bar that's going across from left to right of the chart, that range is about a 3 to 6%, 3 to 6% band, and you can see that rates have largely been in or around that band, with only most recently being substantially below that band, and even the increase in rates that we've experienced over the last 18 months or so has really only brought rates into the middle of the band. So we haven't gotten to an unusual place. We're coming from an unusual place where it's just not normal for savings accounts to have a 0% interest rate, for your mortgage to be a 2% mortgage. I know when I first bought my first house, our mortgage rate was something in the 5 to 6% range, and we managed to get through that. I know there's plenty of people out there that had experience with mortgage rates in the teens. So I'd say if everybody else did it with the teens, I managed to navigate it in the 5 to 6s. Where we are right now doesn't feel all that onerous, and I'd say likewise in the corporate world. If companies are having a hard time running their companies because they've got to pay 5 or 6% on their bank loans or on bonds that they might be issuing, to me, that's not a problem with the Fed. That's a problem with that business and the business model. So I personally disagree with the Wall Street forecast. I think that the rates that we're at right now are here to stay, and I would say hopefully here to stay, because that's a good thing. So this idea about rising tides not lifting all boats. There was a very small subset of the stock market last year that really drove most of the performance, and it's often referred to as the Magnificent Seven. I'm not going to embarrass myself to try and rattle those names off, but they're names like Google, Microsoft, NVIDIA, Tesla, names like that, and I know I didn't just name 7, but there's 3 or 4 more. So what this is both a good news and bad news slide to me. So if you look at when's the last time that we experienced something like this, the numbers along the bottom there are the axis. You go back to 1999, and for those that weren't that need a little bit of a refresher on what happened in history in 1999 and 1998, that was the lead up to the tech bubble. So cab drivers were talking about all the money that they were making in tech stocks. And for those young people that are watching right now, a cab was a yellow vehicle that was driven by a professional driver that picked you up, you paid that person, and then they dropped you off somewhere. That's now been replaced by Uber and Lyft. And again, for you young people, it might be hard to believe, but parents around the world back in the 90s repeatedly told their children, never get into a car with a stranger. Now we do it all the time. So how things have changed. So the good news on this slide actually might look like bad news on the surface. So if you, again, back to 1999, what happened after that led into the bursting of the tech bubble. So that's what happened after 1999. So a reasonable question could be, well, if 2023 looks like the circumstances of 1999, do we have a tech bubble forming? And I would say no and this is a reason why. So this busy chart is a measurement or a tracking of how people are feeling about the stock market. And the blue dotted line across the middle is the average. And basically, when dots are plotted above that blue line, people are enthusiastic about the stock market. When the plot is below that dotted line, people are pessimistic about the stock market. So if you look at the far right-hand corner, what are people thinking about the stock market right now? And there's a fair amount of pessimism that could have a lot to do with what's on the horizon as far as the political scene goes, with the presidential election coming and all the uncertainty around that. It's probably some pandemic overhang. I'm sure there's lots of feelings that go into that. But what's important relative to the last slide is where was opinion, what was the emotional state of the investor regarding the stock market? And that's, you got to go to the tippity top of the chart, back to the 90s, when people again thought everything in the investment world was going to the moon. So another common occurrence in the investment world is whenever you think that it just can't get any better, look out, because the stock market just has a tendency to disappoint. And likewise, just when you think it can't get any worse, also stay hopeful, because it usually turns. And again, that difference between 2022, when we all, myself included, hated all the investments that we had in the portfolio, patience paid off because we were rewarded in 2023. So that's part of the reason why I personally am of the opinion that just because a small subset of stocks really drove returns last year, we're not set up for some catastrophe. In fact, I think that can be a very helpful map to helping you find opportunity. This is another way to think about where is their opportunity. So on the left-hand side of this slide is a chart demonstrating the valuation. So we're using the PE multiple, that stands for price to earnings multiple. And you see in the white box, the green letters, those top 10 stocks that I talked about really driving a lot of the return are substantially pricier than both the overall market and the remaining stocks. And so the S&P 500 is made up of 500 stocks. So Wall Street, never short on creativity. So that means to me, if there are 10 stocks that are pricey, there's 490 stocks that are at some sort of discount. So from an investment perspective, the idea of looking for opportunity in areas of the market that maybe have you've been frustrated with or been disappointed with, or when you go look at your statement, you ask yourself, why do I own this? It hasn't done anything for me for years. You could be looking at an area of the portfolio that actually has got the most promise going forward. Related to that, there's just been a pendulum swing throughout history. This chart goes back to 1971, and it attempts to demonstrate the relative outperformance of the U.S. stock market versus international stock markets. And we are on a 14-year run of U.S. stock markets outperforming the international markets. And there was a time, you do have to go back to the early 2000s, when international stock investing was all the rage. So there's this phrase called the BRIC countries. So that was created by a Wall Street firm, and what it stood for was Brazil, Russia, India, and China. And everybody talked about how you had to be invested overseas. And that pendulum has swung, and it's swung for quite a while now. But it looks like maybe that tide is starting to turn a little bit. Maybe not to necessarily for the international markets to overtake the U.S. markets, but I would say not to be ignored. So this, although it's incredibly busy, it's one of my personal just favorite charts. So the quilt chart. So what this is it's a year by year. The upper row rather in white is demonstrating the years. As you go down each year, so we'll stay on the right-hand side. So that's 2023. As you go down that column in order are going to be various asset classes and their performance for that year. So you've got large cap stocks, DM equity, that stands for developed markets equity. That's basically large cap international. Small caps, a mix, which I'm going to come back to. So the white box, I'm going to come back to that. High yield bonds, real estate, that's what REITs stand for. EM equities, emerging markets, fixed income cash, and then commodities. So just without looking at the detail at all, just looking at the randomness of the colors really tells the story that from one year to the next, one never knows where leadership is going to come from in the investment market, or what's gonna struggle. And so the idea that I'm going to chase the things that have done well, I think is the folly of that from an investment perspective is best demonstrated for me by the emerging markets equity box. So that is EM equity. It's a light purple. So if you go to 2008, that's the third column from the left-hand side. EM equity is all the way down at the bottom. So you hate it. It did the worst. So I'm never gonna invest in this again. Then you go to the next year. So I'm moving left to right across the chart. So light purple, the top. I love it. I got to put everything in there. The next year, it didn't lead the pack, but I did okay. The following year, all the way down at the bottom. I hate it again. The next year, it's almost near to the top. I'm going to go ahead and invest in it, put more money in there. Next year, it's all the way down at the bottom. I hate it again. Bottom, I hate it. It goes back up to the middle. That's a head fake because I'm just coming off of 3 years of it stinking, so there's no way I'm falling for that. But no, the next year, it's all the way up at the top. All right, I missed the boat, so I got to back up the truck and jump back into EM equity. Nope, the next year, it's all the way down at the bottom. Then it goes back up to the middle. I'm not falling for that head fake again. Fool me once, shame on you. Fool me twice, shame on me. The following year, it's all the way up near the top again. I blew it again, but I'll back up to the truck. Nope, it went all the way down to the bottom. And just this roller coaster of chasing performance. So how do you deal with all this uncertainty and protect yourself from the roller coaster? That's the beauty of the white box. So the white box is a mix of these various investments. And you will notice that the white box is never at the bottom or even in the bottom third, and never at the top, but it's in It's in a more narrow channel going from left to right, and a narrow channel from an investment perspective just makes the ride easier to stick with. And that really is the key to success in long-term investing. Not being a genius about what asset classes are going to outperform from one year to the next. I'd say this chart demonstrates that's impossible, but developing a portfolio that you can actually stick with. And boy, should we feel sorry for commodity investors. So that's the green box. And going from left to right, it's almost always at the bottom. It had one day in the sun in 2022 there at the far right-hand side, to only then fall straight back to the bottom, which is why we don't have commodity investments. So the long-term average returns, while accurate, they can be, in terms of the numbers, they can be awfully misleading. So when you look at a 20-year return average, and let's say that number is 9% for a particular investment, the actual year-to-year ride is almost always going to be way more rocky than what that number represents. You're going to have years that are up 15 and years that are down 7. And this chart even breaks that idea down even further to document in any given year, what did the stock market, this is for the S&P 500, what did the stock market do from an overall return perspective, and when and what was its worst point during that year? So again, if we stay on the right-hand side of that slide, 2023, the S&P 500 up above 20%. But at one time during 2023, it was down 10. And if you look at this year by year by year, that's a circumstance that is unavoidable. It is just part of the investment experience. That at some point during the year, you're going to be looking at your investment portfolio and be unhappy. And so being reminded of this is helpful for me, even doing this as long as I have been, but it's helpful for me. I think it's especially important for clients to understand that the ride is always going to be rocky. Unfortunately, that's also true. While the magnitude's different for the bond market, in that those numbers down in red are not as dramatic as the stock market. They're red numbers regardless. So even for the bond side of your portfolio, there's gonna be a time during the course of any calendar year that you're gonna look at the bonds and be frustrated with them. So here's the attempt to walk the tightrope of politics and happiness. I'll be pretty pleased with myself if I pull this trick off. What this chart is going back, looking at various people that have sat in the Oval Office in the president's seat, and looking at the performance again of the stock market over time. And I think what is undeniable, and let's also just have a quick reminder here that we're talking about the investment portfolio only. I'm not making any sort of I'm not attempting to make anyway, or intending to make anyway, any sort of political commentary one way or the other. I'm thinking purely as a capitalist financial advisor. That's it. So I think what's undeniable in this chart is the upward sloping nature of that line, which means that the stock market is growing in value. I think what is also undeniable is that whether it's red or blue, it is also upward sloping. And so if you are a person, so let's go to the right hand, not quite the far right hand side. Let's go to President Barack Obama's picture. If you are a person, and I'm saying this in a judgment-free zone, if you are a person that when President Obama took office, you had the opinion that we were headed for socialism and food stamp lines and soup kitchens and everything else, and you acted on that belief from an investment perspective, you missed out on positive investment performance. There's just no denying that. Likewise, moving one president to the right, if when President Trump took office, and again, I'm talking purely from a financial advisor perspective, just the portfolio, I'm trying to separate myself as best I can from anything else in the political realm right now. But if you believed when President Trump took office that we were all that the country was headed to hell in a handbasket for all the reasons that people that don't think much of President Trump think, and you acted on that from an investment perspective, that also was a bad decision for your portfolio. So in a presidential election year, the good news I'm trying to deliver is that from an investment perspective, just your portfolio, the stock market has demonstrated a wonderful, wonderful ability to look through whoever is sitting in that seat and continue to deliver positive returns. If you take this chart one step further and you think about what else was going on in the world during the course of this during the time frame of this chart, we're talking about the Great Depression, we're talking about world wars, the Vietnam War, a presidential assassination, a presidential resignation, the Great Financial Crisis, domestic 9/11, domestic terrorism, a global pandemic shutdown, and I'll probably stop there with other political events. But the point being, all sorts of bad stuff was going on in the world and in the U.S. And again, the investment markets had this just wonderful ability to look through all of that repeatedly and deliver positive performance. So again, we're not, let's say politics for political discussions for cocktail parties or someplace other than your financial portfolio. Think about that quilt chart, even from a political perspective, and build a diversified portfolio, stick with it, let it do its thing. So before we start thinking about questions, let's think about some takeaways here. So number one, patience pays off. Again, think about how you felt at the end of 2022. Not good from a financial performance perspective, but boy, were you rewarded if you stuck with it. Number two, the Fed's war on inflation, it seems to be working. They seem to be headed towards that mythical soft landing, really walking that tightrope of raising rates to bring inflation down while not destroying the economy. Number three, looking through your portfolio, often the best investment opportunities are the things that you like the least. And even though we're coming off a strong year in the investment world, that does not mean that there aren't other opportunities for you to take advantage of. Also, regardless of whatever investment strategy one pursues, the persistency of the unsmooth ride is just a natural part of the investment process. And no matter how an elephant or a donkey might try to claim that they and their party are better for the economy, I would say the data is overwhelming. The economy, the stock market just looks through whatever it is going on in Washington. So again, save politics for things other than your investment portfolio. So let's see if we've got a few questions. Line 2, I think we've got Bob from Naperville.
Yes, Mark. Great to talk to you. Thanks for taking my call. Long-time listener of your podcast, first-time caller. First question is kind of concerning the real estate market. Are you concerned about the real estate market, the residential real estate market, the commercial market? I'll hang up and listen to your answer. Thank you.
Thanks, Bob. Thank you. Appreciate the kind words. So yeah, real estate, I would say in a similar way that we were talking a little bit about the different parts of the bond market, the real estate market has got different elements. So there's residential real estate, there's office real estate, there's industrial real estate. And just like the bond market, each of those are behaving a little bit differently. What we're hearing from our clients in the industrial real estate space is that it's never been stronger. Residential real estate is also it has also been very strong. Although I think there's maybe some challenges with the rise of interest rates that those people that have got 2 something% mortgages, it's probably going to take them a lot to move. Office real estate, that one feels like the challenges for that part of the real estate market are here to stay. Uh, Fairhaven Wealth Management has won a number of awards with all that's factual, so I'm trying to be as humble as possible for our office space. And so we have not had a challenge in getting people back to work in the office. I think people actually genuinely like coming to work. But that is not, understand, that's not the universal experience around the office market. So I think what might be on the horizon is banks that have got a disproportionate amount of their lending portfolio to office real estate tenants. That could be a challenge. That could be a challenge coming forward. But I'd say overall, the real estate market, I think actually is in fine shape. Fine shape. All right, line 7, Sheila from Oswego. Sheila, what's on your mind?
Hi, Mark. Thanks for taking the call. Um, just thinking long term, what do you feel the impact of alternative energy and climate change could have on the portfolio?
Yeah, great question. Great question. So I think alternative energy is certainly going to be part of the economy. I don't know that what I think it's something about we're all supposed to not have gas cars by I think it's 2035. I find that incredibly hard to believe that we're actually going to get there. I think fossil fuels at some level are going to be a persistent part of the economy, but I think there's also no denying that the role of wind energy, electric vehicles will continue. I think the calling of the demise of the fossil fuel industry at the moment feels a little premature to me. All right, line 3, Steve Lombard, what's going on?
Thanks, Mark. Great information in the presentation. We heard a lot of talk about recession last year in 2022. We didn't have a recession, but what do you see as kind of the recession probability? And then the Fed has talked a lot about a soft landing. What are your views on that?
Yeah, so that's a great question, and you're absolutely right that the forecasts for recessions were abundant. I've lost track of what it even means because when I went to college, I'll admit that was a number of years ago. My memory of the definition of a recession was 2 consecutive quarters of negative GDP, and when we got that not that long ago, that was quickly followed with a no, 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 that wasn't actually a recession. There's like 27 other variables that we need to look at. So I've kind of given up on understanding what the Wall Street prognosticators are even defining a recession as. It yeah but then again, I suppose if you say what a broken clock is right twice every 24 hours. So if you as a Wall Street forecaster just keep saying a recession's coming, a recession's coming, a recession's coming, eventually you'll be right. At the moment, what the data suggests though is that we are far from a recession. At the moment, it looks like Jerome Powell, who's the chairman of the Fed, uh, is is doing a good job of balancing fighting inflation and keeping the economy going. So it remains to be seen. There's also another important investment axiom, and that is when everybody is calling for the same thing, it almost never happens. So the more people scream from the rooftops that recessions are coming, I'd say the less likely I am to believe it. Good question. Good question. Susie, downtown Chicago. What's going on down in the city?
Not much. Doom and gloom, weather-wise. Um, I guess on that note, do you see rates ever going to zero again?
Yeah, so I hope not. I hope not. And the reason I hope not is let's think about back in over the last I don't know 10, 15 years. When did interest rates go to zero? They went to zero. They went to zero or substantially reduced as a response to the tech bubble bursting, the great financial crisis of 2008, uh, 9/11, the global pandemic, times of extreme stress in the economy. In those circumstances, that's when the Fed acted correctly, I believe, to really help take pressure off all of us by cutting rates. So absolutely the right thing to do, but far from normal. So I think it's a great consequence of what the Fed has done in raising rates, that you're looking at savings accounts and you don't have to go out to the third decimal place to find out what your yield is. You're actually getting a return in your savings account. CDs the same way, the fixed income market the same way. I think that is a great consequence of what it is that the Fed has done. So I genuinely I genuinely hope that we don't have rates going to zero anytime soon. What that would mean is that the Fed has really pulled off the soft landing and done its job. So I'm rooting for him. Philip Wheaton, right here in our backyard.
Yeah, it's great to talk to you, and you're just down the street from us. So, I've been losing a little bit of sleep. I've been reading a bunch of stuff on the internet and kind of watching a lot of TV, and there's all kinds of doom and gloom uh, situations out there that just trying to figure out kind of what's real, what's not, what keeps you up at night. There's talk about kind of the U.S. losing its reserve currency, the U.S. dollar. Read some stuff talking about IRAs and those potentially being seized by the government. There's a lot of different things that are kind of concerning me, and too many sleepless nights. Are any of these things kind of, do you feel like they're real, or do you lose sleep over them?
So I'm most concerned about how much time you're spending on the internet. So my fundamental recommendation would be to walk away from the phone or the computer. And I will share with you how I spend my time on the internet, which drives my wife nuts, is watching comedy videos, Saturday Night Live clips, things like that. Nothing about somebody arguing why they're building a bomb shelter in their backyard and stocking it with spam and bottled water because the world's gonna end. So these ideas, the ideas that the government is planning to confiscate our IRA or retirement accounts. To me, that's just somebody trying to get attention on the internet, and you're just not going to get. There's two ways to get attention on the internet. One is to be a fear monger, and then the other one is to be a greed monger. That somebody that goes on the internet looking for eyeballs and says something along the lines of, well, I think what's going to happen is things are going to muddle along, and we'll have some highs and some lows, but overall, we're going to be better off than where we are 5 years from now. That is dead on arrival in internet land. You got to flip a coin, and heads is I think the world's going to zero, and tails is I think we're going to the moon. So I would encourage you, if you're not a big comedy fan, don't do what I do, but maybe a sailing video or learning how to whittle, but spending a little bit more time away from the political world on the internet. Barbara, where are you? Glen Ellen, you are also right down the road from us. What is going on, Barbara?
Yes, I am. I pass by your guys' office every day. I'm just curious what you think the effect AI could have on your business or maybe the finance industry in general.
Yeah, yeah. So lots of talk about AI in the world. So that it's reminding me a lot of the talk about robo advisors a number of years ago. So for those of you that aren't familiar with that, that was a trend where financial advisors like me were all going to lose their jobs because everybody was going to start doing business with a computer. And so the demise of the human financial advisor was widely proclaimed. I don't remember the last time I heard a reference to robo advisors. So I would say I think about AI in the same way that I think about all technology as far as our business is concerned, that it is a way to enhance and augment a relationship that we have with our clients, I'm not concerned at all about it being something that replaces a relationship with our clients. So in our magazine, the Fairhaven Journal, we did write an article using AI and printed that unedited. So we asked I think actually we asked AI what AI thought the role AI was going to play in the financial services world, and then we just reprinted whatever it is that AI had to say. But yeah, I'm not worried about coming into the office one day and finding a robot in my chair. Let's see, do we have any others? Line 7, Sean, down in Orland Park. Sean, what do you have?
Thanks, Mark. Really appreciate all the information. Great information overall. A question you touched on a little earlier in the presentation on the international slide and international stock performance. Can you speak a little bit about the economy both in the U.S. versus the world?
Yeah, so that's a great question. That is a great question. And could we page back to that slide? So that's at the very beginning. It's might be actually, I'm sorry. It's a further forward. Yeah, we're looking for purple, and there we go. There we go. That's it. That's it. So this is a great question. It's important to look at that slide and understand that those bars are not representing economic performance. Those bars are representing the performance of an investment vehicle. So you could think about that as an international mutual fund or an international exchange traded fund or ETF versus a United States mutual fund or a mutual fund that invests in companies that are in the United States. So the world is very much a mixed place. I think Coca-Cola's headquarters are down in Atlanta, Georgia, and something like 60% of their revenues are derived from overseas. It's something on that magnitude. So even though Coca-Cola is a U.S. company, they're doing business overseas. So it would be a mistake and understandably confusing to interpret from this slide that what this is saying is that the U.S. economy is way better than international economies. It's just that U.S.-based companies as investments have outperformed, even though you look under the hood a little bit, and something like Coca-Cola, a meaningful part of their revenues are coming from overseas. So I might have gotten a little bit into the weeds with that. So the fundamental message is don't give up on your international allocation within your portfolio. Well, what incredible engagement. Thank you very much for joining us. Thank you for the engagement with questions. Always makes it better. The goal of these presentations is not to make everybody experts about what's going on in the financial or the investment or financial planning world. So very much encourage people to reach out to us, or you're working with another financial advisor, your own financial advisor for more questions. And then there is always an open invitation to swing by our offices on Roosevelt Road in Wheaton. No invitation is needed. Again, it's an award-winning space, so we love showing it off. So good luck in 2024, and we will see you this time next year.